It's remarkable how often people approach life, and trading for that matter, as if the rules of chaos don't apply to them. They take chances, they overextend, they gamble with what they cannot afford to lose, and then, when disaster strikes, they act surprised. But the truth is, the storm was always coming. You either prepare for it, or you're destroyed by it. That's why position sizing and risk management are not just techniques for financial survival. They are fundamental principles of order itself. If you can't master them, you won't last. If you can, you don't just survive, you thrive. Risk is the very essence of life. Every time you step outside your door, you face it. Every decision you make carries with it the weight of uncertainty. The truth is, there is no such thing as safety without risk, and yet most people spend their lives either pretending that risk doesn't exist or engaging with it recklessly, as though the consequences will somehow not apply to them. In the financial world, in the markets, in trading, this mistake is fatal. Risk is not the enemy. Denial is the enemy. Arrogance is the enemy. What destroys people is not risk itself, but their refusal to recognize its inevitability and their failure to prepare for its consequences. Think about it like this. You cannot avoid storms, but you can build a shelter. You cannot prevent the sea from rising, but you can learn to swim, and you can build a boat strong enough to endure the waves. In markets, it is precisely the same. Risk is everywhere. Every trade you place is a step into uncertainty. You might be wrong, the system might fail, an event beyond your control might unfold, but the trader who thrives, the investor who lasts, the person who succeeds, they don't waste their energy wishing the storm away. Instead, they accept it. They expect it. They plan for it. This acceptance is the foundation of risk management. Because once you admit that you cannot eliminate risk, you free yourself to ask the real question, how do I make sure that when the inevitable happens, when the trade goes against me, when the position fails, I am not destroyed? That shift from denial to acceptance is the mark of maturity. It's the difference between a gambler and a professional. A gambler throws money on the table and hopes luck will carry them through. A professional calculates exactly how much they can lose and then makes certain that no outcome, no matter how brutal, can wipe them out completely. The illusion of certainty is seductive. People love to believe in guarantees, in foolproof systems, in predictions that claim to see the future. And yet, if you live long enough, you realize that certainty is the greatest fraud of all. Nothing is guaranteed. The market doesn't owe you clarity, and it certainly doesn't owe you success. What you can control is not the outcome, but the exposure. You can decide how much of your capital you are willing to risk. You can decide where you draw the line. You can decide in advance that no single trade, no single investment will ever have the power to destroy you. This is why destruction is optional. The markets will always be chaotic, but ruin comes only when you position yourself so recklessly that the inevitable strike wipes you out completely. People often confuse bravery with recklessness. They think taking huge risks is courage. But real courage is knowing the danger, calculating its weight, and stepping into the arena with safeguards in place. Courage is not blind. It's disciplined. Imagine two traders. One puts half his account on a single trade. He tells himself he's confident, that he believes in the setup, that this time he just knows he's right. He might even win for a while. But eventually, the market will turn against him, and when it does, half his capital is gone in an instant. He is shaken, demoralized, often broken. The other trader sizes his position small. He risks a fraction, maybe 1 or 2%. The trade fails, but the loss is manageable. It stings, yes, but it doesn't cripple him. He lives to fight another day. Over time, it is not the bold gambler who wins. It is the disciplined survivor. This principle applies far beyond trading. Think about your life. If you risk everything on one decision, one person, one fragile hope, you expose yourself to the possibility of total collapse. But if you spread your risks, if you act with foresight, if you plan for failure before it arrives, you gain resilience. And resilience is the foundation of strength. So when you face risk, and you always will, remember this: destruction is not inevitable. It happens only when you refuse to respect the reality of uncertainty. It happens only when you take more than you can handle. The wise learn to endure the storm, not by pretending it isn't coming, but by preparing so thoroughly that when it hits, they stand firm. And that, in the end, is what separates those who last from those who vanish. Humility is not a weakness. It is the recognition of your limits, the honest acknowledgement that you are not omniscient, that you can be wrong, that you will be wrong, and that the market has the power to humble you at any moment. Position sizing is the embodiment of that humility. It is the physical, measurable expression of your respect for uncertainty. When you size a trade, you are not simply deciding how much money to risk. You are declaring through action how much you are willing to accept being wrong without it destroying you. It is a deeply human act of restraint, and it separates the arrogant from the disciplined, the reckless from the prepared. Most people enter the market with ego. They think their analysis is flawless, that their strategy is bulletproof, that somehow their intellect or conviction grants them immunity from the brutal truth of randomness. But markets are merciless teachers, and the first lesson they deliver to arrogance is devastation. Overconfidence magnifies losses. Overconfidence leads to oversized positions, and oversized positions turn small mistakes into catastrophic failures. The trader who believes he cannot be wrong ends up betting so heavily that one inevitable miscalculation ends his career. Contrast that with the trader who acts with humility. This person does not presume certainty. Instead, he acknowledges that even the best analysis carries risk, that even the strongest conviction can be shattered by unforeseen events, that probability does not mean guarantee. And so, rather than risk everything, he risks a fraction. He sizes his positions modestly with respect for the unpredictable nature of the world. When he is wrong, as he inevitably will be, the damage is contained. He learns, he adjusts, and he survives. That survival is everything, because survival buys time, and time compounds skill, wisdom, and capital. It's a strange paradox. The person who admits he can be wrong and acts accordingly ends up being right more often in the long run. Why? Because his humility allows him to stay in the game long enough to let probability work in his favor. He does not self-destruct when things go against him. He accepts small losses with grace rather than turning them into disasters with denial. His humility is not passive. It is active discipline, a strategic choice that transforms weakness into strength. Consider what it really means to size a position appropriately. It means saying, I don't know everything, and that's okay. I am strong enough to admit my limitations, and I will not allow my pride to blind me. That act, repeated trade after trade, builds a fortress of resilience. It is not the size of the single victory that matters. It is the accumulation of many battles fought wisely. And that is only possible when each position is sized in proportion to your ability to endure loss. This principle extends far beyond trading. In life, humility is the recognition that you don't have infinite resources of time, energy, or emotional capital. If you pour everything into a single relationship, a single opportunity, a single fragile hope, you make yourself vulnerable to complete collapse if it fails. But if you approach life with humility, acknowledging that not everything will work out, you distribute your effort wisely. You invest in multiple areas. You manage your expectations. You prepare for disappointment. And because of that, you are not destroyed when one path closes. You simply adjust and continue forward. Arrogance says, I will win because I must win. Humility says, I may lose, but I will endure. And the paradox is that humility, though it seems cautious, actually produces greater strength and greater victories in the long run. Position sizing is the disciplined form of that humility. It's saying to the market, I respect your power. I do not control you. I can only control myself. And in that admission, you discover freedom. Because once you are no longer enslaved by the illusion of control, you can focus entirely on the only thing that matters: consistent, disciplined execution over time. Think of the greatest investors and traders in history. They did not survive decades in the markets by being reckless or arrogant, because they understood that humility protects capital. They survived because they knew one truth: every position has the potential to be wrong. And so they never bet so much that being wrong would take them out of the game. They won not because they were always right, but because they were always able to continue. Humility in position sizing is a reminder that you are not battling the market. You are battling yourself. Your fear, your greed, your ego. Every time you size a position correctly, you are not just protecting capital. You are training your mind to respect reality, to bow to truth, to acknowledge that you are human and fallible. That humility is the foundation of mastery. And without it, destruction is inevitable. One of the greatest mistakes people make in the markets and in life is believing they can negotiate with reality after the fact. They enter a position with vague intentions, with no clear boundaries, and when the trade turns against them, they hesitate, they delay. They tell themselves, it will come back. They cling to hope as though hope itself has the power to alter the cold mathematics of risk. But the truth is merciless without limits, with predefined plan for what you are willing to lose. The market will decide for you. And the market always extracts a higher price than you expect. Predefining your loss is not about pessimism. It is about responsibility. It is the act of saying, I know the boundaries of my tolerance. I know what I can afford to lose without being destroyed, and I will not cross that line. It is not weakness, it's strength, because the person who sets limits in advance refuses to let emotion, impulse, or desperation dictate their actions. They choose discipline over chaos. They choose survival over self-delusion. Think about what happens when you fail to define a loss. You enter a position with optimism, convinced that the outcome will be favorable, but markets are unpredictable, and suddenly the trade moves against you. At first, the loss is small, manageable. But instead of cutting it, you rationalize. You tell yourself it's temporary. You wait. The loss grows larger. Now it stings and pride begins to interfere. You don't want to admit you were wrong. You double down on denial, convinced that holding on is the right decision. By the time reality forces you to act, the damage is catastrophic. What could have been a small, acceptable loss has transformed to devastation. Predefining your losses prevents this spiral. When you decide in advance how much you are willing to risk, you strip away the destructive power of hesitation. You no longer need to debate in the heat of the moment when emotions cloud judgment. The decision is already made. If the trade reaches your limit, you exit. No argument. No bargaining. No delay. That clarity is liberation. It protects you from yourself. People think that success in trading comes from brilliant predictions, from perfectly timing entries, from seeing patterns others miss. But more often than not, success is the result of disciplined exits. It is not about how much you make when you are right. It is about how little you lose when you are wrong. Predefined losses ensure that being wrong is never fatal. They keep you in the game, they preserve your capital, and they preserve your mind, because the psychological toll of a massive, uncontrolled loss can be just as destructive as the financial cost. This principle extends beyond markets. In life, you must also define what you are willing to lose before you commit to anything. In relationships, in business ventures, in personal goals, you must ask, if this fails, what am I prepared to sacrifice? What will I not sacrifice? Without those boundaries, you risk everything blindly, and when disappointment comes, as it inevitably does at times, you find yourself shattered because you never set a limit on what you were willing to endure. Setting limits is not about avoiding pain. It is about containing it. Pain is inevitable, but destruction is not. When you predetermine the loss you can tolerate, you transform pain into a lesson rather than a catastrophe. You give yourself the ability to recover, to adapt, to try again. And over time, those small, controlled losses become the stepping stones of growth. They sharpen your judgment, they strengthen your discipline, and they make you wiser. There is also a deeper psychological truth at play here. When you define your losses in advance, you confront fear directly. You no longer operate under the illusion of invincibility. Acknowledge that you can and will be wrong. And in doing so, you strip fear of its paralyzing power. Fear thrives on uncertainty, but when you set your boundaries, there is no uncertainty left about what you will do if things go against you. The decision is made, and you can act without hesitation. That decisiveness, repeated consistently, creates confidence. Not arrogance, but true confidence. The kind built on discipline and foresight. So the act of predefining losses is not just a technical tool, it is a mindset. It is the mindset of responsibility, of maturity, of respect for reality. It says, I will not hand over control of my destiny to chance or impulse. I will decide what I can lose, and I will protect myself from ruin. That mindset is rare, but it is the foundation of every enduring success. Those who lack it eventually collapse under the weight of their uncontrolled risks. Those who possess it endure. Before you can think about growth, You must first ensure survival. This principle is so simple that it seems obvious, yet so many people ignore it. They get intoxicated by visions of rapid wealth, of doubling their accounts, of chasing the next big win. And in doing so, they forget the most basic rule. If you don't protect your capital, you will not be here tomorrow to try again. It is astonishing how many traders, investors, even entrepreneurs burn themselves out not because they lacked intelligence, not because they lacked opportunity, but because they violated this principle. They placed growth ahead of survival, and the price was destruction. Survival is not glamorous. It does not give you the adrenaline rush of big wins. It does not feed your ego with stories of overnight success. And it does not appeal to the part of you that craves instant gratification. But it is the foundation upon which all long-term growth is built. Imagine a tree. Before it can stretch upward toward the sky, it must grow deep roots into the soil. Those roots are invisible, uncelebrated, and often ignored. But without them, the tree cannot withstand the storm. Survival is your root system. Growth is the branches. If you attempt to grow without roots, the first wind will tear you apart. Every trader wants to grow their account, to increase their wealth, to climb higher. But the harsh truth is this: growth without survival is a mirage. You can win big today, but if you risk so much that tomorrow you are wiped out, then what was the point? The true professionals understand this. They are not in the business of chasing fast wins. They are in the business of staying in the game. Because if you stay in the game long enough, compounding takes care of the rest. Growth is the natural consequence of survival repeated day after day, trade after trade. Survival requires restraint. It requires discipline to cut losses when they are small, patience to wait for high quality setups, and humility to accept that protecting capital matters more than chasing dreams of quick riches. You will often feel the pull of temptation, the urge to go bigger, to risk more, to reach for a shortcut. But every shortcut carries hidden danger. The disciplined survivor resists that temptation because he knows what is at stake. He knows that the markets are not kind to arrogance, and that the graveyards of trading are filled with people who could not resist overreaching. Think about the compounding effect. If you protect your capital and grow it slowly, steadily, even modestly, the power of compounding transforms small gains into enormous results over time. But compounding only works if you are still here. Blow up your account once, and compounding resets to zero. Blow up your account twice, and you might not recover at all. It is the consistent survivor, not the reckless gambler, who reaps the rewards of exponential growth. This principle applies to life as much as to trading. In your career, in your relationships, in your health, you cannot pursue growth if you are not first protecting the foundation. A person who burns themselves out chasing promotions will not be around to enjoy success. A person who risks everything emotionally in a relationship without boundaries may not recover when it collapses. A person who ignores their health in the pursuit of money will eventually realize that without survival, all growth becomes meaningless. The order is always the same. Protect the foundation, then build upon it. Survival is not passive. It is not about hiding from risk or avoiding opportunity. It is about engaging with the world in a way that ensures longevity. It is the active decision to play the long game, to endure setbacks without being destroyed to prioritize resilience over thrill seeking. The survivor is not timid. The survivor is strong precisely because they understand what must be preserved at all costs. Many people confuse survival with stagnation. They think that if they are not pushing aggressively, they are falling behind. But that is short-sighted thinking. Real progress comes not from sprinting recklessly, but from walking steadily, consistently, without collapse. The tortoise survives and eventually outpaces the hare because he never leaves the race. The markets reward that same mindset. Small, consistent gains protected by survival strategies will surpass the reckless swings of gamblers who rise quickly but fall even faster. The order is non-negotiable. Survival first, growth second. Growth is meaningless without survival. You cannot expand if you do not endure. You cannot prosper if you do not preserve. The truth is simple, but it is the kind of truth that separates those who last a lifetime from those who vanish in a season. Impulse is seductive. It whispers to you in the heat of the moment, urging you to act without thought, to chase the thrill, to believe that instinct alone is enough to win. In trading, impulse shows up as leveraging after a streak of wins, doubling down on a losing position, entering a trade without analysis because it just feels right. It gives you a rush, a spark of excitement, the illusion of control. But what impulse really does is strip away your defenses. It blinds you to the reality of probability, to the truth of risk, and in doing so, it leaves you vulnerable to destruction. Discipline, by contrast, is not glamorous. It is not thrilling. It does not flood your veins with adrenaline. Discipline is steady, quiet, unyielding. It is the choice to follow your rules when your emotions scream for you to abandon them. And though it lacks the immediate intoxication of impulse, discipline always wins in the long run. The difference between impulse and discipline is the difference between chaos and order. Impulse is reactive, driven by fear, greed, excitement, or desperation. It thrives in uncertainty, but it thrives in a way that consumes you. Discipline, on the other hand, is proactive. It is the decision made before the storm arrives. It is the plan set in stone, followed not because it feels good in the moment, but because you know it leads to survival and success over time. Impulse is a child demanding candy now. Discipline is the adult who understands that patience and restraint lead to greater rewards later. In markets, impulse will always tempt you. When you see a stock spiking upward, impulse tells you to jump in at the top. When you see your trade sinking, impulse begs you to hold on a little longer just in case it turns around. When you've had a string of losses, impulse demands revenge. It wants you to bet big to reclaim your pride. Every one of these impulses feels powerful in the moment, but they all share one trait. They lead you away from rationality, away from structure, away from the very principles that keep you alive. Discipline, however, does not care about momentary feelings. Discipline is the execution of your plan regardless of emotional pressure. It says, I will not chase. I will not hold past my limit. I will not risk more than I decided beforehand. It is calm in the storm, and it is that calm that separates the survivor from the casualty. The strength of discipline is not measured when things are easy. Anyone can follow rules when trades are working out, when life is going smoothly, when the environment feels safe. Discipline is truly tested in adversity, when losses pile up, when fear grips you, when greed pushes you to take reckless shortcuts. The undisciplined crumble under that pressure, but the disciplined endure. They endure not because they feel less emotion, but because they act in alignment with principle rather than emotion. That is the heart of discipline, acting according to truth rather than feeling. Impulse is short-term by nature. It is about immediate gratification, immediate relief, immediate excitement. Discipline is long-term. It is about compounding small gains, protecting capital, and letting consistency build unstoppable momentum over time. In the same way that impulse spending destroys financial stability in life, impulsive trading destroys capital in the markets. And just as disciplined saving and investing create wealth outside the markets, disciplined trading creates sustainable success inside them. The law is the same in every arena of life. Discipline defeats impulse. Discipline is not a restriction, it is freedom. To the impulsive, rules feel like chains. But to the disciplined, rules are structure, and structure is liberation. When you know exactly how you will act in any situation, how much you will risk, where you will exit, when you will enter. You are free from the torment of indecision, from the chaos of emotions pulling you in every direction. That clarity allows you to focus on execution, on improvement, on mastery. Impulse, by contrast, enslaves you. It traps you in cycles of regret, in the pain of repeated mistakes, in the frustration of outcomes dictated by emotion instead of strategy. The truth is, everyone feels impulses. Everyone feels the surge of greed, the stab of fear, the hunger for revenge after a loss. You cannot eliminate those feelings. What you can do is master them through discipline. A discipline is not the absence of emotion. It is the refusal to let emotion dictate your behavior. It is the bridge between intention and action, between knowing what you should do and actually doing it. And in the end, the disciplined trader may not win every battle, but he will always win the war. Because while impulse burns bright and fast, discipline endures.